Okay, hey, good morning, everybody. We're really happy to do this presentation for you guys this morning. And I looked down the registration list. It's nice to see a lot of familiar faces. And for those of you who don't know us well, it's really good to meet you virtually as well. Some housekeeping to begin. We'll break several times for questions because there's some natural breaks in the presentation, and we'll take questions at that time. And you recognizing that it's recognizing this is for CPE credit, I want to read the housekeeping rules associated with that. So to earn full credit, you'll need to attend at least 75 minutes of today's session. We'll post 6 polling questions throughout the webinar. You must answer at least 5 of the 6 polling questions to earn full credit. You don't have to answer the questions correctly. In fact, Mike made them hard, and simply answering them is sufficient. At the end of this webinar, a survey will launch, and while you're not required to complete the survey, we really do appreciate the feedback, and so we appreciate it if you take the time to do that. Your CPE certificate will be sent to the email address you registered with early next week. So the topics for today's session will be the accounting and regulatory context, bigger, the fact that loss rates are not linear, how to use data, Michael will actually go over CECL models. We'll compare warm versus discounted cash flow. We'll look at our model specifically. We'll talk about some key CECL takeaways, and then we'll conclude and take additional questions to the extent there are any. So I'll do the first part of the presentation, basically the first third. Mike Tessier, who runs our ALM and CECL business lines, is going to do the lion's share of the presentation. He's going to go over models, etc. So you're in really good hands with Mike. At the risk of bringing hauling coal to Newcastle, I want to start with the accounting and regulatory context, because I think that it's important to go back to the original purpose of CECL as well as the accounting context, because I think it'll make the presentation a lot. I think it'll make the presentation a lot better. So why in the world did we have CECL? Well, we believe it was in response to the 2008 financial crisis, where the incurred loss model really didn't capture the risk that banks and credit unions were facing going into 2009, 2010. So the standard really contemplated forward-looking estimates, and the goal is timely recognition of expected credit losses. The key features of CECL are it's an allowance for credit losses, ALL goes away. As broad application, we'll talk about that in a minute. There's regulatory guidance. The regulators were wild about implementing CECL or having CECL implemented, and so they actually released pretty soft guidance. Initially, they said, you have to use a broader range of data to estimate lifetime credit losses. You can build on your existing credit risk management systems, and then they recognized that CECL was there's basically different applications for different sizes of institution. Okay, CECL applies to loans, HTM securities, net investment leases, off-balance sheet credit exposures, loan commitments, standby letters of credit, financial guarantees, and similar instruments. Now, the two hardest things I believe on this, in terms of this CECL itself, application of CECL, are loans. It's fairly extensive work on the loan portfolio, and also HTM securities. Maybe they're the most difficult because you have to solve for credit losses, you have to solve for prepayment, and then you have to apply those cash flows into a cash flow waterfall. So I think that the first two items are actually the most difficult to think about. With regard to loan commitments, remember if it's you need to think about whether the commitment is cancelable or non-cancelable. And with regard to off-balance sheet exposures, generally the one we see the most would be a MPF, limited risk exposure, under one of the MPF programs, original or 125. So the major provisions here is it departs from the incurred loss model, the probable threshold is removed, and it results in a day one life of asset loan recognition. Now, this was music to our ears because we've been solving for life of loan credit losses since the start of the firm. And in fact, we go into we start our 23rd year on Tuesday, I'm happy to say. The loss is recognized through an allowance for financial assets, including HTM, we already talked about that, and through a liability for the off-balance sheet exposures that we alluded to on the previous slide. Changes through the allowance, positive or negative, are immediately hit the P&L. Now, I want to spend a minute on this slide because when we read the initial standard, what we, as valuation experts, what it said to us is, oh, you know what, this is the best implementation of CECL is a discounted cash flow model because the net carrying amount should be based on the cash flows an entity expects to collect. Check, discounted cash flow models. Contractual cash flows are adjusted for expected prepayments and defaults. And so you can't, you shouldn't adjust the cash flows for extensions, renewals, or modifications unless the TDR is reasonably expected. But it's interesting, in a cash flow model, you apply prepayment assumptions and default assumptions separately. So we're like, oh, that makes sense. Cash flows expected to be collected are discounted at the effective interest rate. Yep, that makes sense to us. And then we measure losses at a very granular level and then aggregate them up. And Mike will talk about that into detail. As a result of that approach, we're meeting the pooling standard that's cited, that's as part of the standard. So we actually view a discounted cash flow model as the most pure implementation of the CECL standard. Okay, what does it require? You have to consider relevant information, both internal and external. You can't rely on past events. You have to adjust your historical loss information for current asset-specific risk characteristics, current condition, and reasonable and supportable forecasts. Mike will talk about this in detail later on, but it's a little bit easier to think about current and specific risk characteristics if you're actually looking at the loan attributes, credit attributes at the time of measurement, as opposed to using a model that's look back, because then you're trying to infer what the current asset risk characteristics are. You're trying to anticipate how the pool has changed relative to macroeconomic standards in response to current conditions, and then how do you apply the forecast? It's a life of loan estimate, and you can, we don't think it's the best, you can revert to historical loss rates. You can basically revert to the mean if you don't have sufficient, if you don't think that your forecasts are reliable enough. Okay. The standard does not specify a single method for measuring expected credit losses. Smaller and less complex institutions do not have to use costly and complex models, and institutions may apply different modeling methods to different groups of financial assets, and we see that a lot. Now, this regulatory perspective is from the interagency advisory that was released right when CECL became effective. Now, we've done presentations for the FDIC after the fact, and I will tell you that while the FDIC gave people a hall pass in year one of CECL implementation, they are not going to do that now, and they expect that CECL implementation will be commensurate with the size and sophistication of the institution. So simplistic models are not going to make the grade, not going to make the cut with regard to the regulators going forward. We think there are some really good practice aids to help think about CECL. We always start out with the SEC SAB 119, recognizing that SEC basically trumps GAAP, or is the best version of GAAP, or however you want to say that. Shout out to Gabe, who is not on the phone today, I know, but we actually use your guide. We have everybody, the accounting firms all have It's guide to CECL, but we use Moss Adams the best we thought. Gabe did a great job writing that. And then there's an AICPA CECL practice guide that you can look at as well. It focuses on documentation, data reliability, etc. Now it's time for polling question number 1. And Cole, can they see the poll results as it comes through?
I can share it at the end.
Great.
%95% right now.
Yep, so let's share the results. Most people think that it was a response to the financial crisis, and actually improving comparability of estimates across institutions is another important reason. So I think, well answered. Okay, now we're going to talk a little bit about data, and we're going to begin with the fact that loss rates are non-linear, and we'll explain what that means as we go along. So the first thing I want to show you is a slide where we take a pool of loans. I'm actually flipping in my hard copy now, so it's a little too small for my eyes. So we have 1,250,000 of loans, and in the first example, we have them broken out by FICO range and LTV. And you can see that we calculate, from our model, we calculate a 3% loss rate. And if you say, okay, I'm at a more less granular level, and I take the average, so I have 1,250,000 pool, the average FICO is 650, the average LTV is 80, I calculate a loss rate of 1%. So that means that by not being too aggregated in your analysis, it's too high a level, you're actually missing the underlying loss rate. And so it's important to think about the fact that your losses are all in the lower FICO bands, and an average is just not going to capture the risk properly. Okay, this comes from FICO in April of 2024, and we can see from this slide that more than 50% of FICO scores are under 700. So that's an important thing to think about as you're in terms of risk. And there's about 7% of the population has FICOs of 550 to 559, 8% 600 to 650, and that kind of beginning of subprime 650 to 699 is about 11% of the population. So as you're making loans, just recognize the sort of cohorts of risk. Okay, use of data. All right, you want to make sure that you have predictive inputs, and it's the old, statistical standard correlation is not causation. You want to make sure it's granular enough. You want to have relevant look-back periods, and it's going to require use of industry data to supplement. So the question is, do I have a look-back period that has loss content in it? Because a look-back period that says, hey, I've got an average life of 3 years, and so remaining on the loan portfolio, or this pool of loans, I'm gonna look back 3 years. That's all interesting and everything, except that to use that look-back period to forecast with, everything would have to be exactly the same as it was 3 years ago. So I would say look-back period of 3 years is kind of interesting and perfectly useless. And so you want to think about time. You want to have time periods in which there is loss content so that you can infer from that. Okay, and here's my favorite of correlation is not causation. This is the per capita consumption of mozzarella cheese. correlated with civil engineering doctorates awarded, and you can see there's a very high correlation, which means that if you want your daughter to be a civil engineer, you should have her eat pizza. Okay, residential, so we're gonna give you examples of, relevant inputs, that are predictive inputs. So residential real estate loans are highly correlated to FICO and LTV. It's not enough to have one or the other. And if you think about that, if I have a 550, 50% LTV loan, I might go into default, but it might not either, because they've got so much equity in the house. And even if it does go into default, I've got very limited loss content. So it's important to have both FICO and combined LTV when you're thinking about it. On commercial real estate, the loan performance is highly correlated to debt service coverage ratio and LTV. C&I loans is highly correlated to industry, and auto loans is highly correlated to the type of loan. FICO score, loan term, and unemployment rate. So we'll go through these examples that really illustrate the fact. Okay, let's look at slide 20, where we're comparing LTV, FICO, and so we're comparing LTV and FICO. And if you look at the loans here where there's a LTV of greater than 120%, you can see that even with decent FICO scores, you're still seeing a fairly high loss rate. And that's because we think it was two things. One is if you're underwater, you're just more apt to mail the keys, right? Even if you have a high FICO score. Or if you're in a lower FICO score and you're underwater with respect to LTV, you can't do anything about it. So you can't refinance. It's difficult. If you sell, you're going to sell at a loss. And so it's really important to think about LTV and FICO combined with respect to residential real estate loans. And I remember I was at a Moss Adams presentation many years ago in Milliman, where the experts, they were actually insurance actuaries based in New England. They calculate the reserve for Bank of America, or calculate the reserve for Bank of America at the time. And I remember the exact presentation that the presenter said it's LTV and FICO combined. I'm in the audience nodding my head saying, yep, it's LTV and FICO combined. Okay, if you think about residential real estate loans, what are they sensitive to? Well, they're sensitive to change in housing prices. It's obvious that the credit worthiness of the borrower, credit scores, loan to value ratios, prepayments, and market volatility. What's important in this slide is that if you're looking at these loans at a high level, at an aggregated level, you're missing a lot of things. And then what I mean by that is if you look at the default rates, they plummeted in 2020 and 2021, but at the same time, what you're not capturing here is that prepayments were huge in those years, and so you're not dividing the data or separating the data in a way that makes it useful. Commercial loans. Okay, so commercial loans, it's borrower credit quality, it's industry-specific risks. So there's a big difference between retail, hospitality, office, manufacturing. It depends on whether you've got a balloon payment. It depends on how the loan's structured with regard to variable interest rates. It depends on whether it's collateral and guarantees. I'm going to give an example of office. So commercial real estate, office, it's really important to think about geography. So downtown Minneapolis, doing fine. Downtown St. Paul, death spiral. And so the risk characteristics of commercial real estate in those two geographies are completely different. This is a slide that comes from Fannie Mae multifamily data. I believe it goes back to 2000. and it shows an extremely high correlation between debt service coverage ratio and LTV. You know, if you have a low debt service coverage ratio and a high LTV, you're gonna have a high incidence of default. That's just how it is. Now, this is an example of why you should think about SBA loans at the NAICS code level. And the reason for that is that it varies significantly by type of industry. And so that the very best loan you can make is to a veterinary service. And one of the worst loans you can make is to a gas station or hotel or motel. They're very different risk characteristics. There's very different loss performance. And by the way, this goes back to SBA data from 1991. Now, we do work for the top 5 SBA originators in the US. And I guarantee you that they understand these statistics extremely well. And in fact, when you look at the top SBA originator in the US, their portfolio of loans corresponds extremely closely to the low risk loans that we're seeing on this chart. Ag's really hard. And so as one of my accounting colleagues said, well, all you have to worry about is weather and bugs. And other than that, you can predict performance. So we actually go with risk rating. When we're doing a portfolio that's ag bank, we're going to rely on their risk ratings for the most part. Consumer loans, you've got a shorter loan term so that you've got less prepayment volatility. You can still have significant credit risk variability. It's going to depend whether it's secured or unsecured. Do I have a credit card or do I have personal line of credit, that kind of thing. And then it's obviously, they're sensitive to macroeconomics as well. Okay, this is one of my favorite slides. It comes out of our research. And so it's another example of granularity. And it's important to break the portfolio, an auto portfolio, down between new vehicle direct, used vehicle direct, new vehicle indirect, used vehicle indirect. And you can see new vehicle direct is very strong in terms of performance. Used vehicle indirect is 4 times worse. And so if you're modeling at, say, new vehicles, or you're modeling at used vehicles, you're not properly capturing the risk. So the more granular is the more predictive. You have to make sure that you have a statistically valid sample, and most institutions are not going to have that. If you have a statistically valid sample of losses, you're probably not around. And so you need to introduce industry data, and we do that through a concept called credibility theory. All right, this is another illustration of granularity. So now we took used vehicle direct, we broke it by FICO bands, and then we look at what happens with respect to the CDR, so the incidence of default. And you can see 780 plus, infinitesimal default rate, used vehicle direct delinquent 90 days, 80% default rate. Now, you think, hey Doug, that's pretty anal. Well, what I would say to you is that we do this, and then we add long term to it. Because if you have a 620 8-year loan term, you actually don't have a loan, you have a rebilling process. It's just, it's the loan was made to get the person in the car, and it was made by a dealer who wanted to move the sheet metal. Okay, we spend an absolute fortune on data. And so we use S&P Global. We've looked at research from Moody's and Fitch. We constantly look at research that comes out of Experian, especially with regard to auto loans. We subscribe to Bloomberg. We look at Regulation AB reporting that comes out on Bloomberg. We've FOIA'd the SBA database back to 1991. We have Fannie Mae multifamily loss information that goes back to 2000. We've looked at Freddie Mac's performance in connection with, we have to do work for a securitizer multifamily loans, and so we've looked at their deals extensively. And most importantly, I'd rather be lucky than good. We have a database of loans where we have performance information that goes back prior to the Great Recession, so we're talking 2006, 2007, that is based on credit union loans, so consumer loans, residential real estate loans, with updated FICOs and updated LTVs. And so that data set enables us to go extremely deep with respect to modeling. Questions?
No questions yet.
Okay, well, okay, this was, let us know, we'll have a little time at the end, hopefully, and I'm gonna turn it over to Mike, who's gonna go, he's gonna take us nearly to the end, and then I'll wrap it up.
Perfect, thank you. So now we'll walk through the different CECL models that institutions can use to estimate those expected credit losses. As kind of we all know, and Doug had mentioned, CECL is designed to improve how we estimate losses by taking a life of asset view, meaning that we're not just looking at historical experience, but also considering those current conditions and then reasonable forecasts about what's ahead. And so what's important to remember with all of the models is that CECL doesn't lock you into one specific or rigid method. There's actually several different approaches that you can use. And the right model really depends on the portfolio, the lending strategies of the institution, and then the overall risk profile. So the main thing is whatever model you choose, it has to reasonably estimate expected losses over the full life of the asset, and then it has to make sense given how that institution is structured. Before getting into the different models, I'll take some time to cover what CECL actually requires from a modeling standpoint and also what it doesn't require. So at the end of the day, every CECL model has to estimate expected losses over the full life of the loan. But the key point is that the estimate needs to reflect the average outcome or the expected outcome, not just the most likely one. So this is the mean outcome instead of the mode outcome. There's a full range of possible credit outcomes for any given loan, and if you only model the most likely scenario, you're probably underestimating that loss exposure, and that's why CECL is focusing on the average as opposed to the mean expected loss. The other thing to understand with CECL is that it requires us to account for the time value of money, but it doesn't say that you have to use a discounted cash flow. So the standard does have language that recognizes that the amortized cost of that loan would already reflect some of the time value of money to some degree. But the models, like the discounted cash flow model, is explicitly incorporating that into the cash flows, whereas other approaches like a loss rate model, roll rate model, or PDLGD model generally factor in that time value of money more in an indirect manner, typically through how those loss assumptions are applied. So the bottom line there is that while the standard gives you plenty of flexibility, you have to choose an approach that's practical and relevant for the portfolio and for the actual data. And then regardless of the method, you really have to do three specific things, which are estimating lifetime of expected credit losses, so full life of the loan. It has to reflect the average expected outcome, not just the best or worst case. And then it has to incorporate reasonable and supportable forward-looking information, ideally for large economic drivers like unemployment, like interest rates, or changes in collateral values. All right, so with some of the basics out of the way, I'll run through the different CECL models that are out there. I'm sure plenty of you have seen most of these already. So I'll hit the highlights and then point out where they work well and sort of where they fall short. So the lineup of what I'll go through here is we have the snapshot model or pool-based models, we have vintage models, we have migration or transition models, and then probability of default and loss given default, really just PDLGD models. Weighted average remaining maturity, which most of us call WARM, and then finally the discounted cash flow model, or DCF. So as we go through each one, I'll kind of give an overview of how they work, where they're used, and then really where limitations start to show up with each one of them. We'll focus most of our time on the discounted cash flow model. because that approach, we believe, is the most predictive forward-looking reserve estimate, especially for full institution portfolios or any complex portfolios, or even during times when the economy is a little shaky, which has been the norm lately. So the first CECL model we'll talk about is the snapshot model. You might also hear it called pool-based or static pool model. The idea is pretty straightforward. You take loans or other financial assets that share similar risk characteristics, things like product type, credit score, loan term, whatever it may be. You group them into pools. Once they're grouped, you apply a historical loss to each pool and then estimate expected credit losses that way. This approach is good for large, fairly simple portfolios, so unsecured consumer loans, credit cards, or smaller dollar retail lending. Any situation where it doesn't really make sense to do an individual loan level risk analysis, or anywhere where some of that more detailed data is just not available. The big advantage of this model is really just that it's simple and efficient, so it's really easy to implement. It doesn't take a lot of operational lift. It's very simple math, and it's kind of great for lower risk, stable portfolios, and it'll work in that way. But the problem with simplistic models is that it does come with a trade-off. So the snapshot model is leaning heavily on qualitative adjustments or Q factors, because those loss rates are applied at the pool level and they're based on historical data. So as Doug had mentioned, when you are not granular enough with the pool level and you look only at historical data, what you're missing is any dispersions in credit that have happened between prior periods and current periods, as well as any future shifts moving forward. So any potential changes in unemployment into the future, any changes in collateral values into the future, there's no way to directly incorporate that into these snapshot models. So for a stable portfolio, this is pretty manageable, but for a more complex portfolio, and really for any institution of size that has varying loan products, you would want more precision, more granular dynamic modeling to get a better picture of what credit risk would look like. Next up, we have the vintage model, which is taking a different approach to estimating expected credit losses. With this method, we're tracking how loans perform based on origination date. Most of us call that vintage. So you're basically grouping loans by the year or quarter, whatever it may be, that they were originated, and then looking at how those groups perform historically over time. The vintage model does give some insight into changes like underwriting standards, changes in borrower profiles, or even the broader economy, but only to the extent that they influence those specific batches of loans. So for example, if we look at loans originated in 2007, right before the financial crisis, they performed a lot differently than loans that originated in 2010 after underwriting standards were tightened up. So by tracking that performance across vintage, we can look at patterns and try to get a sense of where those trends will go. And that's one of the advantages, is that you can see some of those trends evolve over time. But like every model, the limitations here is that we're looking at historical data. You need good, consistent historical data at whatever segmentation you're using, and you have to approach it with origination date. The other issue with that is that we all know that every single vintage is going to perform differently. And if we rely too heavily on the performance of past vintages, we might miss some of future changes in economics that would influence how newer vintages would behave. So even with good data, the vintage model is still based on historical performance. So you still have to layer in those adjustments to reflect reasonable and supportable forecasts. So it's a good indication that you can improve some transparency around loss patterns year by year with origination data. But if you have a lot of credit variation or a more complex portfolio, or as the economy starts to sour, or if we're in a recession and the economy starts to improve, you would need a more sort of advanced dynamic approach to get at an accurate loss estimate. Next, we have the migration model, which is commonly called transition model, risk migration model, whatever it is. They're all talking about the same general approach. So with this method, we track how loans move between different risk categories over time. And those categories generally are internal risk ratings or delinquency buckets, or any other system that an institution would use to monitor credit. Most of the time we see this with risk rating. We don't see it very often with credit scores or FICO scores. But the basic idea It's pretty simple. Any changes in credit quality are usually an early warning sign for potential defaults or losses. So by looking at how loans have historically migrated from one category to another, so from moving from a pass to a special mention or from current to 30 days delinquent, you can get a more dynamic estimate of where those losses might be headed. We typically see this with commercial loan portfolios or any portfolio where there's a strong internal risk rating process that's in place with a kind of a dedicated team that continues to track all of that. It nicely builds off of how a lot of institutions already monitor credit quality and brings those assessments directly into that loss estimate. But it also has some limitations. So for this to work, you do have to have reliable and consistently updated and applied risk ratings. But if you have different loan officers or different credit teams working on different cohorts, and we get inconsistent risk ratings, then the model sort of loses its predictive power. Or if some of that historical migration data is spotty or not tracked on a consistent basis, your loss estimates start to suffer that way. So these work well with institutions and teams that have those processes in place and continue to track that data in a very consistent manner. It's a step up in sophistication from a snapshot or a vintage model, but it still leaves out some of those forward-looking estimates that could be related to unemployment or specific changes in underwriting or just consistency in data across the institution. Next one we'll cover is the probability of default and loss given default model. So PDLGD is it's commonly referred to. You'll hear this one mentioned a lot. It's a more common framework. A lot of institutions use this, at least for a portion of their portfolios, and it tends to work well for some of the more complex portfolios where data is available to do this. So the way this works is we break apart expected credit losses into two clear pieces. The first being probability of default, or PD, basically the likelihood that the borrower is going to default within a certain time period. Depending on the vendor or the model, this is usually annually or just an estimate over the life of the loan. And then that second piece is the loss given default, or the LGD, which is estimating how much of the loan you're expected to lose if the default actually occurs. So this will take in factors like collateral, any guarantees, or if it's a auto loan, whatever you would get on the repossession of that loan, if it's a mortgage, whatever that value of that home is worth. So by splitting these two pieces apart, the PDLGD model gives us sort of a more granular approach that is more sensitive to those credit risk factors that we talked about earlier. It's useful for portfolios that do have a wide range of credit profiles if you have enough data to stratify the existing portfolio and the historical data that same way. So if you can look at different collateral types at different levels of risk characteristics, this model generally will work fairly well. But again, typically it's the probability of default is going to be based on historical data. It's a little bit easier to adjust for borrower credit quality, but again, it's only based on that historical data. The loss given default side then is coming from historical recovery rates. Most institutions track this fairly well and can get at product level recovery rates to incorporate that. So this would take into account any of collateral values, liquidation processes, sometimes the timing of those liquidations, and then any market trends. We see this a lot across banking and capital markets, especially for commercial real estate and commercial and industrial lending, as well as just general secured consumer loans. Really anywhere that credit worthiness and collateral recovery are kind of the main components, given its PD and LGD. The strength of this model is how it can adapt to more dynamic economic environments. You can adjust both the default probability and the severity one way or the other based on forward-looking forecasts, which does produce a more responsive and accurate number. But again, you need really solid data to do this, especially if that default and recovery data is available. It needs to be as granular as you're going to model it. So if you don't have enough of your own experience, or if an institution doesn't have enough of its own experience, it's going to have to rely on industry or peer data, which is often really hard to find at that same level of granularity. So the bottom line is this model does give you a structured and transparent way to estimate credit losses with more precision than sort of a broad-based loss estimate. but it does require kind of stronger data, stronger governance to be able to use it right. Next up, we have the WARM model, so weighted average remaining maturity. Most people just call it WARM. This is likely one of the most common approaches and models that we see. This one is also extremely simple. So you're applying historical loss rates to a pool of loans and then project those losses over the pool's remaining average life or contractual life. In practice, this means you're figuring out average time left until the expected payoff of that loan or of that pool based on contractual terms, ideally incorporating repayment, ideally incorporating some default information as well. And then you multiply that amount by an annualized loss rate estimate to get at total lifetime expected losses. So WARM is a very practical and very streamlined option, especially for a very simple portfolio. Kind of where building out a more granular model doesn't work, or if you don't have the data available, as any given institution often does not. So the main selling point is simplicity. It doesn't require as much infrastructure. It doesn't require as much data as maybe a discount cash flow or a PDLGD model might. But like other simple models, there's obviously limitations to using weighted average remaining maturity. So if we're only using historical loss rates based on the assumption that the portfolio credit quality of where those historical losses were made up, market conditions where those losses came out of, and then those patterns, if those stay stable over time, then the weighted average remaining maturity model, the WARM model, would work pretty well. But what happens is we miss things like risk migration, shifts in credit quality, or changes in collateral values, all of which obviously are significantly impactful to loss expectations, especially when we have an economy that moves relatively quickly, or if underwriting standards change, if the institution is trying to get ahead of that, then there's enough potential to over reserve that way. The other issue with a WARM model is that it's also very sensitive to how the remaining maturity then is calculated. So if those prepayments aren't factored in accurately, or if those assumptions are too simplistic, too high level, those loss estimates will be way off. And then on top of that, you're still in need of all of those qualitative adjustments to layer in forward-looking information, just like all those other models. So if you lean entirely on historical averages without adjusting for changes in unemployment, changes in collateral values, or even just interest rates into the future, you risk kind of reserves being too high or too low, depending on the environment that we're in. So really, WARM is a very cost-effective option for simpler and more stable portfolios, but its predictive power decreases significantly when you're dealing with a more credit-sensitive or economically exposed loan portfolio. In most cases, you would want that more granular dynamic model. All right, so the last model we're going to cover today then is the one we'll spend the most time on, which is the discounted cash flow model, or DCF. This is often seen, and we strongly believe that this is the most comprehensive and forward-looking approach under CECL that you could take. And in simple terms, we're projecting future contractual cash flows of a loan or a pool of loans. That's going to include the contractual payments, so contractual principal, contractual interest, and then we're comparing that to what the institution would actually expect. So we make adjustments for prepayments, we make adjustments for default, and we make adjustments for loss severity as well, based on sort of what we expect to collect, and then incorporating those economic indicators like unemployment, housing price appreciation, based on reasonable and supportable assumptions. The difference between that value that we come up with in the discounted cash flow approach and the amortized cost is going to get us that CECL, or that current expected credit loss amount, that ends up on the financial statements. So this one tends to be far more reliable, especially when we have a lot of complexity in loan portfolios, which we see at banks and credit unions. They have plenty of borrowers, plenty of different loan types, plenty of different geographies. What we like so much about DCF is that it is explicitly forward-looking. So unlike simpler models that are just leaning on historical averages, we are building in reasonable and supportable forecasts for things like prepayments, defaults, loss severity, unemployment, housing price appreciation, all of that. And with that, we're also accounting for the time value of money explicitly in the way that we're calculating. So we're discounting cash flows back to get to the present value using the effective interest rate of the loan, which is directly stated in the standard. And it's super important to do that for longer term portfolios like long-term fixed rate mortgages, even longer term adjustable rate mortgages, any commercial loan with a complex payment structure, or any type of loan that has significant differences in credit risk from one borrower to the next. Third, the discounted cash flow model handles that complexity really well, whether it's residential real estate, commercial real estate, auto loans, credit card loans, fintech loans. All of those things can be incorporated into the discounted cash flow model, where we can incorporate considerations for collateral value, changes in behavior across product types in terms of prepayments, in terms of default, and then any of those economic trends. So defaults on auto loans increase more than defaults on mortgage loans when unemployment increases. We can incorporate all that information directly into the model to get a more predictive, transparent, auditable, whatever word we want to use there, to get a very strong answer that we have a lot of confidence in. So yes, the DCF model does take a lot of data and more operational effort, but in turn, it gives you the most comprehensive, risk-sensitive, forward-looking loss estimate that you're going to get, making it a great fit for any of those portfolios where we have a lot of variability in credit quality, changes in collateral value, or just general exposure to market volatility. And then to help bring the discounted cash flow model to life, I have a quick example here, but we can walk through this. So for this example, we're modeling one single loan, $100 million loan, 10-year term, 5% interest rate. To keep the math clean and focus on bigger picture, we've made a couple of simplifying assumptions. So we have a 12-month liquidation timeline in the event of default, 15% conditional repayment rate, so expecting 15% of that balance to repay each year, 1% conditional default rate representing a chance of default in each period, and then a 20% loss severity, so a 20% loss in the event of default. Projection schedule here is showing that these assumptions play out over the life of that 10-year loan. So each year we have the cash flows broken into sort of 4 primary buckets, one being the scheduled amortization, one being voluntary prepayments from that 15%, one being the default rate from that 1% CDR, and then the associated losses based on that 20% severity. So as we work through each period, both prepayments and defaults reduce that loan balance, while the losses are reflected in those ultimate cash flows where we don't expect to receive those. So once we have those cash flows built out, models discounting them back to present value using the effective interest rate, which is 5% in this case, consistent with requirements for CECL. High level, the math here is working out. So those discounted values are around $97 million compared to the $100 million balance of that loan. That $3 million difference then is going to be the expected credit loss for this loan. So in a real world application, we layer in macroeconomic factors as well. So we'd adjust the model default rates based on unemployment trends, and then that severity, the 20% severity, would change based on projected changes in collateral value. So doing so gives us the ability to factor in borrower behavior, credit risk, prepayments, and then recoveries to build a very granular forward-looking loss estimate that will give us reasonable forecasts and also capturing the time value of money, so the timing of all of those losses as well. In practice, we apply this across thousands of loans with different borrower profiles, different loan types, different economic assumptions, different geographies. Typically, we do this at the monthly projection period rather than annually, but all of the underlying mechanics remain the same for the entire portfolio. And I'll pause here for the next polling question. We set, Cole?
Yep, I closed the book.
Perfect. So I'll get into the discounted cash flow in a little bit more detail, but before doing that, obviously I've thrown a lot of terms around, so just giving some background on what these terms are and what you'll see as you go through different CECL models. First, there's probability of default, which is the likelihood that that borrower defaults within a certain time frame. We express this annually, but under CECL, a lot of times you'll see it as sort of a lifetime probability of default. Next is the loss given default. So that's the percentage of exposure you would expect to lose if a default happens. This would consider collateral, any guarantees, or any other potential source of recovery. Basically, the LGD is how severe the loss is, not just the chance of default. So then you'll also hear, which is at the bottom, going out of order, but you'll hear the term severity, which is basically the same thing as LGD. Both are describing the portion of the balance you expect to lose after any recoveries. So we use severity in our model, but in PD-LGD, you'll see LGD obviously used more often. Then we have exposure at default, or EAD. That's the total outstanding principal balance at the time of default, including both any principal and accrued interest. Having this as an accurate projection kind of gives it that reliable estimate. So in a discounted cash flow model, the exposure at default is going to be the balance of that loan at the time of default within any projection period. And then we also need to focus on some prepayment side information. So especially in a discounted cash flow model, we have the conditional repayment rate, or CRR. This is reflecting the annual percentage of voluntary repayments you would expect, meaning extra principal payments outside of any scheduled payments that are not tied to defaults. And then we are also incorporating conditional default rate, or CDR, which is the annual expected amount of default for that given loan. So putting those together gives us a CPR, which is probably more commonly seen in other models, which is inclusive of CRR and CDR. And when we do our analysis, we show CRR, CDR, and CPR, and the CRR is just the sum of the two. And I think we have another polling question as well before this section. I think we made this one pretty easy.
All right, close.
Perfect. So before we jump into a side-by-side comparison, I want to set the stage for why warm versus DCF conversation even matters. These two models are fundamentally different, and the warm is probably the most common, and the DCF we believe is the best. But they're different not just in how they calculate expected losses, but kind of just across the board. So they handle macroeconomic forecasts differently, they approach the data differently, and they vary a lot in terms of how predictive they actually are. So especially when we have any shifts in the economic environment. So that's why this comparison is important, because the model that ultimately gets used is going to have a big impact on how reliable and how responsive the reserve estimates actually are. Okay, so I know this is a small chart, but I'll try to go through this relatively quickly, breaking down side-by-side differences between warm and discounted cash flow. First is the methodology. Warm is very simple, historical loss rates over the remaining life of the loan pool, very retrospective, very aggregated. Discounted cash flow model is a lot more precise, projecting cash flows period by period, adjusting for prepayment default severity, and then discounting everything back to present value to get those expected losses. Second item is macroeconomic considerations. So warm doesn't naturally bring in a lot of forward-looking data. It's mostly historical. So that's why you have to layer in a bunch of Q factors. With discounted cash flow, we can take unemployment, we can take property values, we can build those directly into the cash flow projections and get a much more responsive result. The third piece then is just the math behind the credit loss calculation. So warm, probability of default, and loss severity get combined into one sort of average loss rate, if you will. It's very simple, but the simplicity comes sort of at the expense of precision. With discounted cash flow, we can keep those pieces separate. We can keep very accurate estimates at the loan level for each component, modeling defaults and severity independently, getting much more detailed results. Fourth then is that data granularity. WARM generally is lumping loans together into broad pools, so different credit scores, terms, LTVs. All those get averaged out, which loses some visibility into those risk differences. With discounted cash flow, we can look at those loans individually or in very detailed cohorts tied to those credit attributes, which gives us the ability to include more updated information. So kind of the frequency at which you run would be updated credit scores, updated collateral values. We can incorporate updated forward curves. All of those are reflected into the discounted cash flow model. The next one is model complexity. WARM is very simple and looks backward. DCF is more complex, but also forward-looking, bringing in those loan level attributes and those economic considerations. The next piece is prepayments. We see that WARM is often missing the mark on prepayments because it's leaning on those historical averages, which don't really reflect today's market, or the prepayment assumptions that are used in that WARM analysis are far too aggregated to get an accurate estimate. So really, we have a lot of variability across loan products, across loan types, across loan terms, interest rates, and across institutions. So if they're all using the same prepayment assumption, they're all going to get very incorrect results. Discounted cash flow models, we're incorporating those prepayments directly into the modeling. So looking at borrower incentives, current interest rates, updated loan information. So again, continuously updated, active, dynamic, responsive results. Seventh then is just the use case of one model versus the other. WARM is a bit of a one-trick pony. It's used for reserve estimation and not much else. You get a number, you put it on your balance sheet, and you move forward. Discounted cash flow is a lot more versatility. You can use it for CECL. You can also use it for pricing. You can use it for stress testing. You can incorporate those credit attributes into ALM modeling. You can use it for portfolio risk management, product development, whatever it is. CECL is a very flexible tool to do all of those things. Second to last, we have adjustments. So WARM, again, you need a lot of Q factors to make up for the limitations. If you have a really strong team that's really apprised of what's going on in the world and at the financial institution, you can do a great job with Q factors. Majority of the time, there's not enough effort or time or emphasis placed on where those Q factors come from, how to calculate them, and how to actually incorporate them to get a realistic reserve. So with discounted cash flow, since you're modeling those risk factors directly into the guts of the model, you need fewer external adjustments. And then lastly, we have predictive power. So WARM is just less predictive. It's designed to be less predictive. That's just the nature of how it works, especially when the economy falls behind quickly. Discounted cash flow model is built to adjust dynamically. So as credit changes, as collateral values change, as unemployment changes, those loss estimates are going to remain forward-looking and remain relevant and reliable across any given cycle. So no matter what model an institution uses, whether it be WARM or discounted cash flows or something else, there's a couple of what we would consider non-negotiables that apply across the board. And we've discussed these briefly, but first and notably most important is the need to bring in additional macroeconomic considerations. So CECL is forward-looking. It has to be forward-looking. Historical data is a great starting point, but you have to adjust for loss estimates to reflect reasonable and supportable forecasts for unemployment, for housing prices, ideally incorporating repayment in there as well. The second is the models need to reflect relevant forward-looking information, so not just historical averages. That means your projection should be based on the best available data that you have. So ideally, every valuation date is updated to the specific date you're valuing, and then tailored to the specific portfolio and aligned with what you or what the institution expects in terms of market conditions. Third is you can and absolutely should use external industry data, but it has to be relevant and reliable. You can't just apply peer averages without thinking about whether they actually reflect your institution's portfolio, geography, risk profile, loan mix, whatever it may be. And then finally, CECL is requiring life of loan loss estimates So models are going to have to account for prepayments and defaults and just other real world borrower behavior. So loans almost never perform exactly as scheduled, and the model has to reflect that to get an accurate and defensible number. So these requirements are going to apply to any model that you see, but as we've talked about, more granular approaches like discounted cash flows are tending to handle these much better and much more naturally, which means you're not as dependent on sort of big subjective adjustments to make those results work. So this is the same chart that Doug had earlier, but I'll circle back to why that model granularity is such a big deal when we're talking about estimating expected credit losses. Most models, WARM included, are going to apply a total loss rate based on historical averages. But as Doug explained, loss rates are nowhere near linear. They don't behave the same across credit profiles. They're not the same across loan types, and even different economic environments or geographies, they tend to be much different. The more granular the model is, meaning the more it accounts for borrower credit, collateral values, and other risk differences or risk ratings, the more predictive and responsive it becomes, especially when we see volatility in the environment. So we have to remember credit scores migrate over time, collateral values fluctuate, loans don't stay static. If your model's not adjusting for those changes, your estimates are going to miss the mark. So that's a big reason why the discounted cash flow model performs better. We're pulling in updated borrower information, updated collateral data. We can adjust dynamically, which is just improving all of our predictive power. So here's an example of how a WARM model would have played out during the Great Financial Crisis and the years that followed. So we did this using real portfolio data from our multi-billion-dollar, multi-year data set. You can see that WARM is significantly understating the reserve needs in 2009, right when those defaults and economic stresses hit their peak. That happens because this WARM is leaning so heavily on historical loss rates, and those rates lag behind in fast-moving environments. So only a few years into recovery, WARM is doing the opposite. We're failing to release those reserves fast enough, so you have excess reserves sitting on the books, even as that credit performance improved pretty significantly. And so this is the core limitation we see with a WARM model, is that it's backward looking by nature, which makes it slow to respond to those rapid economic swings, which generally is going to lead to under reserving when losses are rising and over reserving on the back end of that. Similarly, we can look at a discounted cash flow over that same period. Because the discounted cash flow model we have is using that loan level granularity, updated credit profiles, updated collateral values, building in forward-looking economic scenarios, we're adjusting dynamically as those conditions change, both during the crisis and then during the recovery. So the result is a model that is far more accurate, timely reserve estimates. Those reserves increased proportionally during the peak stresses and then released when those credit conditions started to stabilize, and then continued to release as they started to significantly improve. Sort of exactly what we would expect and exactly what we would want to happen. So that's why we think the DCF model is kind of the most predictive and reliable approach, especially for any portfolios that do have economic exposure and then where we see a lot of variability in credit quality over time. So looking at the two side by side, we can sort of boil it down to a couple takeaways over that full 14-year period we have. First off, the total net provision expense over the time comes in pretty similar between both models, right around 21 million. But how that expense plays out over time is where the real difference shows up. WARM method is significantly understating reserves in 2009, right when defaults peaked during that financial crisis, and then under reserving creates a lot of risk, especially if we have regulators and auditors looking at that balance sheet and looking at that portfolio. Then in the recovery period, especially right around that 2014 mark, WARM model's doing the exact opposite. We're holding on to excess reserves longer than we need to, meaning we have capital tied up. We're sort of limiting ourselves from a liquidity standpoint and hindering ourselves potentially from a competitive standpoint as well. If we look at the discounted cash flow model, we're tracking much more dynamically. So we build reserves pretty quickly during the downturn and then releasing them appropriately as conditions continue to improve. That's the primary benefit of the granular loan level inputs and then those forward-looking assumptions. So both kind of, we end up in a similar spot over the long haul. Discounted cash flow is much more responsive and predictive, and generally more regulator friendly in terms of the reserve profile, which is going to be even more important for institutions that are dealing with those credit cycles. So I know that was a lot of information, so I'll stop now for questions, and then after this we have our next polling question as well.
Looks like we don't have any questions so far, Mike.
Perfect. You want to queue up that next polling question, please, Cole?
Yep.
Thank you.
All right, the poll's closed.
Awesome. Thank you. So before I get into the Willery Win model and talking about our assumptions and our specific results, I want to take a second to sort of introduce the approach that we take and how that fits into a broader CECL context or conversation. At Willery Win, we have built a loan level discounted cash flow model designed specifically to meet CECL's life of loan and forward-looking requirements, but also to give institutions a more predictive, reliable estimate. So we're doing that by incorporating more than a decade's worth of historical loan performance that we have at borrower level risk characteristics, and then dynamic economic forecasts as well, all being applied consistently down at the individual loan or very detailed cohort level. What's really setting our approach apart then is the combination of that statistical rigor with economic sensitivity and real world validation. And when I say real world validation, I mean that really the strength of any model is going to come down to one thing, which is how well it actually predicts credit losses. Our discounted cash flow models are consistently showing a high level of predictive accuracy, and I have a couple examples of that. In 2023, across our entire client base, our model projected net charge-offs of 40 basis points, and the actual observed loss rates that came in during that time period were 39 basis points, so basically spot on. And then in 2024, the model forecasted losses were 68 basis points, and the actual charge-offs came in at 63 basis points. Again, showing really close alignment between what we modeled and then what actually happened. So this level of accuracy is obviously showing a few strengths in how we approach CECL and the modeling. First is, and almost more importantly, is applying those loan level assumptions based on real borrower credit profiles, real collateral values, and the actual loan characteristics that we have in all of those portfolios. The second piece is then integrating those economic forecasts directly into the cash flow projections. So not layering them on afterward, but fully baked into the model. And then third, we are consistently refining and backtesting the model using actual portfolio performance to make sure it stays credible over time and to make sure that we're sort of continuing to capture evolving trends on an ongoing basis. So in short, when a discounted cash flow model is built the right way and applied consistently, we get reserve estimates that are just more than just compliant for CECL, but we're actually giving up, or we're actually showing real world results and how they compare to actual modeled losses, and that they continue to be very accurate. Excuse me. Now I want to make an important distinction about how the modeling process actually works, especially since we're talking about a discounted cash flow framework. So a little bit of a disclaimer, if you will. So yes, we are applying statistical assumptions, things like prepayment rates, default rates, and loss severities at the loan level. But to be clear, we're not trying to go in and predict exactly what will happen for each individual loan in isolation. Mathematically, the model shows the way the math is working in the model is that a small percentage of each loan is going to prepay, and a small percentage of that same loan is also going to default in any given period, which obviously is impossible. So a loan either defaults or it doesn't, and a loan either prepays or it doesn't. But that's within the model, that's by design. The goal of the model is to apply a sound risk-based assumptions across the entire portfolio so that the aggregate results, meaning those projected cash flows and expected losses and the resulting CECL reserves, are accurate and reliable at the portfolio level based on the attributes of the portfolio. So the approach that we're taking is completely aligned with CECL requirements. We're using large data sets, we're using historical trends, borrower segmentation are driving all of those inputs. We're not making loan by loan predictions, but we're producing defensible institution-wide loss estimates. So with that, we kind of have some key components that go into our modeling. It really comes down to these sort of 5 core inputs. Each one reflects both loan level and portfolio level risk factors. First one being the conditional repayment rate. So for us, as I mentioned, this is the annual percentage of voluntary prepayments, basically how much of that balance a borrower is going to pay down ahead of actual contractual payment dates. Second is the conditional default rate, which is the annual amount that we expect to default. And then the 2 of those combined is the CPR. Fourth is that loss severity, also the loss given default, whatever you want to call it. This is the percentage that we expect to lose after accounting for recoveries based on any collateral that we have, whether it be real collateral like a home or an auto or just a piece of insurance. The 5th one then is the discount rate. So in CECL, when we're using a discounted cash flow model, the discount rate has to be the effective yield of the loan, so not a market rate, not some risk-adjusted spread. This is keeping everything aligned with how CECL ties loss estimates back to amortized costs and make sure that the time value of money is built directly into the modeling. And so when we have these inputs and we derive them properly, the model can project those cash flows, account for credit risk and borrower behavior, and calculate the present value of what that institution would actually expect to collect over time. So now we can break down sort of how we come up with probably the most critical assumption that goes into the model being the conditional default rate. So our process starts with that proprietary loan level data set dating all the way back to 2008. Credit union industry-wide, billions of dollars worth of loan performance history in there. So we have full economic cycle coverage, both growth periods and major stress events. Financial crisis is in there. COVID era is in there as well. We're using that historical data to analyze real loan performance across a range of borrower and collateral characteristics, which allows us to build default assumptions tailored to those very specific risk segments and then apply them at the detailed loan level based on the attributes of any given loan. So the main drivers of those initial CDRs are coming down to characteristics like credit score, loan to value, loan term or structure, loan type, as well as delinquency status. We stratify loans based on these attributes and then apply the default rates derived from actual historical performance within each one of those buckets. And then naturally the higher risk groups, so higher LTVs, lower credit scores, are carrying higher default assumptions, while those lower risk groups get more favorable treatment. That's kind of a stratified data-driven approach, is making sure that we're reflecting any given institution's actual risk profile, not just applying broad averages across the board. So we're tailoring to a very specific portfolio every time we run the model. And because we apply the CDRs at the loan level, the model is then dynamically adjusting as that portfolio changes over time. So every time we value it, every time those credit scores change, the model input assumptions change as well. So the initial default rates are sort of the foundation of our loss estimate. And then from there, we're layering in additional predictive adjustments based on forward-looking economic conditions, which we'll get into next. So once we have established those conditional default rates based on all of those loan level risk factors, the next key step is applying predictive adjustments. So this is how we make sure that the model is forward-looking and aligned with all of those CECL requirements to be reasonable and supportable forecasts. So we do that by bringing in macroeconomic factors that we know through data analysis, through statistical analysis, have a real valid relationship to that deposit or to that default behavior. The most common and most impactful that we use in our model is the unemployment rate. So it's a clear, measurable economic driver that's tied directly to borrower performance. We can look at how unemployment has historically moved both up and down and track those trends across different geographic levels, so whether it be national, state, or MSA, to understand how it is influencing those default rates. That's sort of the basis for making sure the model adjusts dynamically, so we're not just using historical losses, but really looking at sort of real economic conditions as they change over time. So how do we actually quantify the impact of changes in unemployment on that default rate? We're doing that through a regression analysis, basically using the data that we have to measure how changes in unemployment historically are influencing those default rates. So first, we'll run a regression analysis to establish that relationship, looking at how defaults have moved in response to changing unemployment over time. Second, we are calculating the beta or sensitivity that will tell us how much we expect default rates to change for every percentage point move in the unemployment rate. And then we're looking at the R squared, really just to validate how strong those relationships are, making sure it's obviously statistically significant and that the model is giving us a reliable and predictive result. Finally, we'll take that relationship and apply it dynamically within the model. So as macroeconomic forecasts shift, the CDRs are adjusting right along with them. And so an example of how that works in the model is if we're projecting an increase in unemployment using those regression relationships, the modeled CDR, the model default rate, will increase right along with it, or similarly decrease if we have that projected as well. So this is how we're transforming the model from being sort of grounded in historical information, but also continuing to be forward-looking, which is exactly what the whole CECL standard is designed to require. Then for institutions that operate in specific regions or serve certain markets, we can take it a bit further by using that refined, localized data. So this is, instead of just relying on national unemployment numbers, we can pull in state level or even MSA level unemployment trends to make sure all of these inputs are aligning with the risk profile of the portfolio. So I can tell you that Portland is going to perform far differently than Des Moines. So as you can see, the statistical relationship we have between unemployments and defaults is going to hold whether we're looking at national data, state data, or MSA level data. So the modeling that we're doing is staying relevant and responsive no matter where the borrowers are located. By combining the detailed loan level characteristics with the statistically valid economic-based adjustments, the model produces sort of more reliable scenario-sensitive default projections that are actually responding to changes in borrower risk and market conditions. So you can see it in the table here. We have replicated the changes in unemployment from the Great Financial Crisis, Great Recession, and calculated that projected default rates have looked like throughout that entire modeling period. Same process applies no matter what scenario we're looking at. So whether it's a downturn or recovery or just stable unemployment, that's what's making our model dynamic and responsive. We're adjusting to both where that current unemployment rate is, but also where we expect it to go moving forward. In addition to credit scores and other indicators like unemployment, we're taking collateral value into play as well. Obviously very important on the real estate side. And we do that through incorporating housing price appreciation into our model. So we see this obviously as a predictive input on collateral value trends. Changes in property values are going to affect both the chance of default and also how severe the loss is going to be if that default occurs. The logic we use here is pretty straightforward. So if a borrower has solid equity in the property, they're a lot less likely to default. But if we have negative equity, as Doug said, it's really easy to just mail the keys in and be done with it. So to model that accurately, we are bringing in projected collateral value appreciation at the geographic level, again, aligning with those same geographies that we have on the unemployment side, so everything remains consistent. What's important here, and in this example, updated collateral values are flowing directly into both the default probability and the loss severity assumptions that we have in the model. So this is giving us a fully integrated dynamic framework that's adjusting as market conditions change. For example, we can take the same loan and run it using state level projections or drill down even further to the MSA level. Results are similar, but there's a nuance here. And in this case, the Portland MSA is experiencing worse performance than the state of Oregon overall. So an institution that's solely lending in Portland probably has a bit more risk than that institution that has lending statewide. So this is how that discounted cash flow model is reflecting more than just those static loan attributes. We're bringing in those real world conditions, those real world projections specific to where those loans actually exist to make sure that the projections are relevant and realistic. I think I'll pause right here. We have our, should be fifth polling question.
All right, I'm gonna close the poll.
Awesome. Unemployment rate. All right, so this chart is a good example of the kind of detail that we can pull out of the model when we're working at the loan level. So what you're seeing here is how we can break out the results and break them down across different risk characteristics. What's that, Doug?
We can't see your screen.
All right, let me.
Can we take it over?
Can try.
You back?
No.
No.
That's it. Yep.
Okay, it's back.
Okay, perfect. Thank you. But as I was saying, this is a great example of what we can do with the results. So since we're running everything at the loan level, we can aggregate those outputs into meaningful categories. So things like credit score, loan to value ratio, and then delinquency status as well. So instead of just getting one reserve number for the whole portfolio, we can see exactly how those losses vary by segment. For example, higher LTV loans or lower FICO bands are going to have higher expected losses, which is exactly what you would want to see and exactly what you would expect to see. This gives our clients a much more complete picture of where they stand from a credit perspective. So we see it as much more than just CECL compliance. This is a strategic tool that an institution can use to make better lending decisions, to better manage risk, or even to think about pricing and product strategy. So really it takes what a lot of institutions and clients feels like a regulatory exercise, and we're turning it into something that can add real value for them in terms of managing that portfolio and just in general managing the institution. All right, so that wraps up my section. I will hand it back over to Doug to close us out for today.
Yeah, we're gonna skip credibility theory. We had it in there just in case we started to run short and but actually running short of time, and so instead of material. If you're interested, if you just have to know how credibility theory works, then we've got a white paper called Implementing CECL. We can grab it on our website. So, the message perspective is, discounted cash flow models are more reliable, provided that you've got the right level of granularity, and in order to have predictive accuracy. It's much easier to implement the standard in a discounted cash flow model than it is a retrospective model, because you're starting with what are the loan attributes of the modeling date, what are the forecasted economic conditions going forward. It's a much easier way to implement the standard from a conceptual standpoint. Now, there's a lot, it's messy to audit and to look at because there's a lot of data there. But on the other hand, I always say the proof's in the pudding. And so you saw how accurate our model has been over the last couple of years. And in fact, it's been extremely accurate for a long time. So what can you use a discounted cash flow model for, in addition to just calculating a CECL reserve, right? You can have, I think we lost you again, right? You can use it for you can incorporate it into ALM modeling, which is what we do. So your NEV in the base case scenario is CECL. You can use it to stress test. So I'm going to say that the unemployment rate moves from where it is today to double or triple. And well, how much capital do I have at risk? I can think about loan pricing optimization. So, there's this pool of indirect auto loans, 660 FICO score. What am I making enough? Is the interest rate high enough to cover losses in forecasted unemployment scenario, an unemployment scenario that's twice as bad as today? How much capital do I have at risk? The other thing that's important here is that the discounted cash model, the way we use it, is that we're using the same primary inputs that the institution used to make loans, right? So it's FICO, it's LTV. So you have a really good way of communicating amongst your team about, hey, I don't want to make more 660, 95 LTV residential real estate loans. That's a very direct thing to tell your lending department. Or, hey, we're being adversely selected by this particular used indirect dealer. I don't want to deal with them anymore. The alternative in a warm model is to say, hey, let's not make any loans like we made in 2008. Right, it's too broad of idea in order to be able to implement effectively. So I know that we went really deep, and we did that on purpose. And so I think as you come away from our seminar today, and you want to know more, then I'd encourage you to go to our website and just look at things in detail. The key CECL takeaways for us are: is it a forward-looking approach? The granularity enhances accuracy. Model choice matters. The importance of credit and collateral data. You have to make adjustments for macroeconomic conditions. There's obviously limitations on retrospective models. So now I hope what we've given you today are the tools that you need to go into an audit, to go into a financial institution and be able to ask really good questions about how did they calculate the reserve, what do I need to worry about, what can I take away, what can I recommend to the client, etc. As I say, we are happy to answer any questions that anybody has at any time. And I think we have one more poll call.
Yeah, one more poll. I'll launch right now.
Great. Okay, everybody, thanks so much for your time and attention today. And with that, we'll close. And do please fill out the survey. We're really interested in understanding how we enjoyed the session or not enjoyed the session, and how we can do better in the future. Thanks again.